The headlines are a seductive lie. They scream of victory. Credit cards slashed to 10%. Mortgages crash below 6%. They want you to believe the long nightmare of inflation and crippling debt is over. They are telling you a bedtime story. The truth, the cold, hard, dangerous truth, is that what you're witnessing in January 2026 is not an economic miracle. It is the most radical, the most perilous experiment in American monetary history in over half a century. The price of money itself, the very interest rates that govern your loans, your savings, the entire heartbeat of the economy, is no longer being set by markets or by independent guardians. It is being set by one man in one office for one purpose: to win an election. The President of the United States has declared war on financial reality. And in this war, there are no bystanders, only casualties. Welcome to the era of political money. Welcome to the great repricing. And if you don't understand the battle lines, you will be financially wiped out. Let's pull back the curtain on Washington, D.C. right now. On one side of this silent war stands a president, fresh from a second-term victory, but staring at a looming midterm judgment. His political survival hinges on a single, visceral feeling: making life feel affordable again. The numbers are a screaming indictment. Credit card debt has pierced the trillion-dollar ceiling, a monstrous weight on the national psyche. The average interest rate on that debt is a punishing 21%. Mortgage rates, the gateway to the American dream, have been cemented near 7%. The anger is palpable, a low-frequency hum in every town hall and diner. His base is not just frustrated, they are financially suffocating. On the other side stands an institution designed to be a fortress against this very pressure: the Federal Reserve. Since 1913, its purpose has been to be the adult in the room, to make the unpopular, painful decisions, to raise rates when the economy overheats, even if it costs politicians their jobs. Its independence is not a bureaucratic formality. It is the bedrock of global trust in the American dollar. That bedrock is now cracking. The opening salvo was not a policy paper, but a legal missile. On January 15th, 2026, the Department of Justice served grand jury subpoenas to the Federal Reserve Board. The official reason? Alleged cost overruns in the renovation of the Fed's headquarters. A building inspection. In Washington, a city that speaks in whispers and power, everyone heard the deafening subtext. This was a pretext. This was the legal groundwork. The meticulous laying of bricks to construct a case for removing Fed Chair Jerome Powell for cause before his term expires. The Federal Reserve Act is clear. A chair can only be removed for inefficiency, neglect of duty, or malfeasance. Policy disagreement is not a firing offense, but find a speck of administrative dust, magnify it under the lens of a politically weaponized justice system, and you have your lever. The global markets, those vast digital nervous systems of fear and greed, understood in nanoseconds what this meant. This was an assault on the firewall. Within 48 hours, gold, the ancient haven from human folly, soared past $4,600 an ounce. The dollar, the world's reserve currency, began to wilt against the euro and the yen. But the most telling reaction was in the bond market. Traders didn't just sell, they fled, though they weren't selling because of data on inflation or growth. They were selling because the last independent referee was being escorted from the field. They were pricing in a new, terrifying variable: political risk. That term, once reserved for emerging markets with volatile regimes, was now being attached to United States Treasury bonds. The Sell America trade had begun. It is what happens when the world decides that the safest assets on Earth now carry the contagion of politics. This is not a theory. This is a playbook, its pages stained with history. We have seen this movie before. In the early 1970s, a president, fearing electoral defeat, pressured a pliant Fed chairman to hold rates artificially low. The chairman complied. The result was not prosperity, but a decade of runaway inflation that ultimately required a painful, brutal recession to excise. The names change. The dynamics of power and panic do not. The firewall is burning, and the spark has just been thrown. But the assault on the Fed was just the opening move, because what happened next, on a symbolic January morning, was the policy coup de grace. A move that sounds like a gift to every struggling family, but is, in reality, a meticulously designed trap for the most vulnerable. And this is where the video takes a shocking turn. On January 20th, 2026, surrounded by fanfare and framed as a triumph for the common man, the presidential decree took effect, a nationwide cap of 10% on all credit card interest rates. The narrative was pristine, a political masterstroke. The greedy banks charging 25%, 30%, even 35% were finally being put in their place. The little guy was catching a break. It is a beautiful story. And like all beautiful stories, it is a fiction. To understand why, you need to see the cold arithmetic behind the plastic in your wallet. Credit card pricing is not arbitrary. It is a fragile ecosystem built on risk. A bank's base cost to borrow money is tied to the prime rate. Let's say that rate is 6.75%. A 10% cap leaves a margin of just 3.25 percentage points. From that sliver, the bank must pay for everything. First, credit losses. When people don't pay, the bank eats the cost. For reliable borrowers, losses might be 2 and 3%. But for the nearly 50 million Americans with subprime credit scores, FICO below 1660, default rates can rocket past 10%. The math instantly collapses. Then add operating costs, customer service, fraud departments, transaction networks, another 2-3%. Then the regulatory cost of holding capital reserves against the loans. And what about those shiny rewards, the airline miles, the cashback? They are not gifts. They are subsidized entirely by the interest paid by those carrying balances. The American Bankers Association did the real math. Under a 10% cap, between 82% and 88% of all credit card accounts become deeply, existentially unprofitable. Not a bad quarter. A bleeding wound. So what does a rational business do with a product that loses money? It stops selling it. It closes the account. Now, follow the human consequence. The single mother with a 620 credit score. Her transmission fails. She needs around $200 now, not in 6 months when she's saved up. Her credit card, her lifeline in past emergencies, is gone. The bank closed it. Where does she go? The shadow economy. Payday lenders, where effective APRs reach 400%. Pawn shops, surrendering family heirlooms for pennies. Car title loans, where a missed payment means losing your vehicle, your means to work. And in the darkest corners, illegal loan sharks where late fees are replaced with threats of violence. The cruel, devastating irony is this. A policy sold as protection from 25% debt will shove millions into 400% debt, or into the hands of men who break bones. As one economist starkly put it, we're creating credit deserts for the people who need credit most, and the pain radiates outward. Your local credit union, the member-owned co-op that serves teachers, firefighters, small communities, is not a Wall Street villain. Yet they have penned desperate letters warning this decree will force them to stop lending to their own neighbors. The entire rewards economy, every free flight, every hotel upgrade you've ever earned, was paid for by the cross-subsidy from interest revenue. Erase that revenue, and the points become meaningless paper. This isn't just a rate cap. It is a systematic dismantling of mainstream consumer credit. But the manipulation doesn't stop at your wallet. It reaches for the very cornerstone of American wealth, the home. In early January, the White House directed the Federal Housing Finance Agency to command the mortgage giants, Fannie Mae and Freddie Mac, to deploy $200 billion of their precious capital reserves to buy up mortgages. The goal? Flood the market, push bond prices up, and magically force mortgage rates below 6%. It worked for a headline. Rates dipped. Champagne corks popped in press releases. Here's what the headlines buried. The combined capital buffer of these two entities, which backstop over half the nation's mortgages, is roughly $180 billion. The president ordered them to spend $200 billion. He commanded them to spend more than their entire financial life savings. This capital was painstakingly built up after the 2008 crisis, a blood-soaked lesson, specifically to protect taxpayers from another catastrophic bailout. That buffer is now being set on fire to buy midterm election votes. The dream of a privatized, stable housing finance system is dead. What sane private investor would ever inject capital into an entity whose reserves can be looted by political decree? Yet, even the staggering raid on the housing system misses the most sinister long-term effect of all. Because when you corrupt the price of money itself, you don't just distort markets, you poison the very engine of capitalism. And most people never hear the next part. And that's the real danger waiting just over the horizon. We have seen the tactical strikes, the neutering of the Fed, the gutting of credit, the looting of mortgage reserves. But now, zoom out. See the architecture being constructed around you. It has a name, economists whisper, financial repression. It is a government strategy to systematically keep interest rates below the rate of inflation. It is a silent, invisible tax on anyone who dares to save money in a bank account or a bond. Your cash, your safety net, slowly rots from the inside out. Picture the landscape of 2026. Inflation is sticky at 3%. The Fed's target is 2%. The textbook cure is higher rates, a bitter medicine. But the political imperative is cheap money, a sugar high. If the president succeeds in forcing the Fed to cut, here is the dystopia we bake, the zombie economy. Artificially low rates keep the walking dead alive. Companies that produce nothing, innovate nothing, but shuffle forward because the cost of servicing their debt is kept on life support. They consume capital, talent, and resources that should flow to vibrant, new, productive enterprises. In a healthy capitalist system, rising rates are a forest fire. They are painful, they destroy the weak and the old, but they clear the ground for new. The rot builds unseen until the entire ecosystem collapses under its own weight. This is the true great repricing. Everything you know is being revalued. Stock prices no longer signal corporate health, but political favor. Home prices no longer signal shelter and scarcity, but distorted state-injected demand. Your 3.7% high-yield savings account in a 3% plus inflation world guarantees you a loss in purchasing power. What are you forced to do? To avoid erosion, you must chase yield. You fling your savings into an already inflated stock market, speculative crypto, or overpriced real estate. Assets pumped up by the same cheap money policies that doomed your savings. It is a rigged game, a financial hamster wheel. And for the government, this repression is a feature, not a bug. The United States cradles $34 trillion in national debt. Negative real interest rates, where inflation exceeds the rate you pay, are a magic trick. They melt that debt away by stealth. Who pays for the trick? The holders of the debt, your pension fund, your parents' retirement bonds, the foreign nations that trusted America's word. They take the invisible haircut. Your future is being inflated away to pay for today's political victory. So, what do? How do you navigate a world where the compass of price is broken? I'm not a financial advisor, but I can offer a framework for thought. First, abandon the old religion. Cash is no longer safety. In an era of repression, cash is a melting ice cube. Its value evaporates to serve political ends. Second, think in hard assets. Gold's meteoric rise is a scream into the void about lost trust. Productive real estate, farmland, critical commodities, things that cannot be printed with a keystroke, regain their ancient primacy. Third, diversify your sovereignty. The Sell America trade is a warning. If the credibility of American institutions is negotiable, then some portion of your wealth should exist beyond their immediate grasp, in assets, accounts, or currencies tied to other jurisdictions. Fourth, beware the debt gift. That 10% credit card rate may feel like relief, but policies born of political panic are transient. What happens when the cap expires or is overturned? When your rate snaps back to 25%, will you be trapped? Use any respite not to borrow more, but to dig out. We are living through a fundamental transformation. The signals that guide 1 trillion daily economic decisions, the cost of credit, the value of currency, are being manually overwritten by political commands. History has a clear label for this: a managed economy. And managed economies do not end with innovation and prosperity. They end with shortages, black markets, and catastrophic corrections when reality finally batters down the door. The question for 2026 is not whether we will repeat the stagflation of the 1970s. The bones of that lesson are already rattling in the closet. The question is whether we, as individuals, will recognize the storm for what it is before it washes away our financial foundations. I'm not optimistic about the short-term politics, but I'm determined to be prepared. You should be too. Because in the great repricing, there are no spectators. Only those who see the numbers behind the headlines and those who are about to become a number in someone else's calculation. This isn't just economics, it's a tale of power, fear, and the fragile trust that holds our system together. If you want to understand more of these hidden stories, the human dramas behind the charts and the headlines, subscribe to Economic Tales. We don't just report the news, we uncover the narrative, because in a world of political money, knowledge isn't just power, it's your only defense.